Welcome to Introduction to Farm and Ranch Taxes.
Hi, I'm Poppy Davis. I teach a class in agricultural taxation at the University of Arkansas School of Law LL.M program in agricultural and food law. I'm the primary author of these materials in close collaboration with my friend and colleague Winona Doris. Winona is a business skills consultant and trainer who works with farmers, ranchers, and fishers. She leads training on accounting, taxation, insurance, and cash flow at both the state and national level. Winona comes to agriculture through familial ties from her great uncle, Ed Scott, who was a successful claimant in the Pigford case against the USDA. Winona holds a BA in economics and accounting, a master's in business administration, a graduate master's certificate in taxation, and is licensed as an insurance agent and a tax preparer.
And it's my pleasure to introduce my friend and colleague, Poppy Davis. Poppy is a consultant and business skills advisor to agricultural and food and beverage enterprises and to nonprofits and local governments. She has worked as a CPA and at the United States Department of Agriculture and in various nonprofits. She holds a Juris Doctorate from Drake University Law School, a master's in journalism from Georgetown, and a BS in agricultural economics from the University of California at Davis.
The LL.M program in agricultural and food law at the University of Arkansas School of Law has been a leader in agricultural and food law for more than 40 years. It has nationally recognized faculty, specially designed courses, on-campus and distance options, and for more information, you are encouraged to go to the website.
This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary and no attempt is made to discuss state-specific laws. For advice on how these issues might apply to your individual situation, consult an attorney. This project and materials created by Poppy Davis as part of the LL.M program of agricultural and food law at the University of Arkansas School of Law is part of the Agricultural Finance, Tax, and Asset Protection Program.
The Ag Financial Tax and Asset Protection Program has resources to enhance farmers, ranchers, educators, and others' ability to understand and navigate business tax and asset protection decisions.
There are a total of 5 lessons in this series.
For each lesson, there's a short questionnaire to help you decide if the lesson is right for you. Each lesson also includes a PowerPoint, a recording of the PowerPoint, and a PDF file with detailed supplemental information, including the presenter's script, additional topics for discussion and engagement, and additional resources.
Welcome to Lesson 3, Introduction to Farm and Ranch Taxes.
There are a total of 5 lessons in this series. This training covers how income and self-employment taxes are calculated. It includes detailed discussions of self-employment income issues, including how to ensure that both spouses are paying into Social Security and Medicare, and the optional farm method for self-employment taxes and the earned income tax credit.
In this lesson, we will start out with a look at the tax formula for an individual and see where income earned from a business is reported on your individual tax return. Next, we will focus on self-employment income and self-employment taxes, and then we will take a look at 2 important considerations: the qualified business income deduction and the earned income tax credit.
The face of the 1040 is a summary of all sources of income. Each line may have several forms and schedules that provide detail on the amount reported on the Form 1040. Schedule F for farm or ranch activity is just one of many forms you may need to attach to your 1040.
All income together equals adjusted gross income. This is the amount used to qualify or disqualify people from all sorts of programs. It is also the number economists use when they talk about household income. After adjusted gross income, various items are subtracted to come to taxable income. Income tax is calculated on taxable income using IRS tax tables.
If you have self-employment earnings, self-employment tax is calculated in addition to regular income tax. In general, Native Americans have the same income tax filing requirements as anyone else, but there is a special exemption related to income derived from the land. This exemption is only applicable to enrolled members of federally recognized tribes and only with respect to income derived from either lands that were put into trust under an act of Congress that specifically exempted income from the land from taxation, or on lands that are subject to a treaty which has been interpreted to include language exempting income derived from the land from taxation. For more information, see When is Tribal Farm and Ranch Income Exempt from Federal Taxes, a publication from Utah State Rural Tax Education.
Sometimes trusts pay income taxes, but partnerships and S corporations always pass all taxable income through to the owners. Pass-through income is reported by the entity on a Form K-1. The K-1 goes to the IRS at the same time it goes to you. You report your K-1 income on Schedule E of your Form 1040. If the pass-through income you receive is from a farm or ranch business, your K-1 should include a statement about gross income from agricultural activities. You may need this number to qualify for certain benefits only available to farmers, such as the ability to pay optional self-employment taxes.
Trusts, partnerships, and S corporations file information returns with the IRS. This is similar to an employer filing 1099s or copies of W-2s with the IRS. When you receive a K-1, you must include the information from it on your tax return. You will likely receive a notice from the IRS if you fail to include the K-1 information, or if the numbers on the K-1 do not match the numbers you reported on your tax return. We will discuss entities and entity tax returns in more detail in Lesson 4. You can also get more information from the IRS website by looking at the web pages for partnerships, S corporations, and trusts.
Business net income is total income less total expenses. Money you put into or take out of the business is not part of the net income equation. There is not necessarily any relationship between cash you withdraw from your business and the taxable net income of the business. You could take out a loan for the business, withdraw the proceeds for yourself, and have a loss on the business even though you took money for yourself. Or you could make a profit in the business, but not take home any money for yourself. You are taxed on the net income of the business, income less expenses, regardless of what cash you take out of the business or what cash you put into the business.
Sometimes people talk about farmers needing to pay themselves. This is actually confusing because most farmers operate as sole proprietorships or partnerships, or as limited liability companies filing taxes as partnerships. And these types of entities may not pay W-2 wages to the owners. Owners are free to deposit money into or withdraw money from the accounts of the businesses they own, subject to nothing but agreements with other owners. For tax purposes, it does not matter what the owners put in or take out. They are taxed on their share of the net income of the business. Remember your first paycheck? Remember how crushed you were at how much less it was than what you expected? That was partly because Social Security and Medicare taxes were withheld from you. Your employer sent that money to the IRS on your behalf and also paid an equal amount on your behalf.
If you have employees, you are paying half of their Social Security and Medicare tax each time you deposit federal payroll taxes. When you are self-employed, you are the employee and the employer. So you pay both sides of the Social Security and Medicare tax. The idea is to make sure self-employed people pay into Social Security and Medicare the same as wage employees.
Medicare is available to people who have a significant disability and to those over 65. Those who've paid Medicare taxes for at least 10 years qualify for basic Medicare with no premium. Those with no work history may have to pay for basic Medicare.
Social Security is based on your earnings record or the taxes you have paid into the Social Security Trust Fund. In order to qualify, a person must have enough work credits and must be 62 or older or have a significant disability or blindness. Work credits are an amount determined by the Social Security Administration. The amount is subject to change, but generally a person can earn up to 4 work credits in a year. In 2023, a work credit is $1,640 in earnings from wages or self-employment.
One reason to get kids working, and I mean legally and appropriately, but working on payroll as soon as possible, is to ensure they will qualify for basic benefits if they become disabled early in life. That would be a terrible thing to happen, but it would be even worse if it happened and they did not qualify. Additional retirement savings and disability insurance investments should be in addition to ensuring that you can access Social Security and Medicare.
Okay, the exact limits to qualify to make optional self-employment tax payments may change from year to year. Currently, you will qualify if gross farm income is less than approximately $9,000 or net farm income is less than approximately $6,500. A qualifying farmer may elect to pay self-employment tax on 66 2/3% of gross income up to a limit set at approximately $6,000.
Rental income is generally not subject to self-employment tax. However, qualified farm rental income can be used as part of the gross income for purposes of calculating optional self-employment taxes using the farm method. You may also make optional self-employment payments using the non-farm method, and you can make them using both methods. For additional information, see IRS instructions to Form SE, the Pub 225, and the optional method for paying self-employment taxes at ruraltax.org.
Most small business corporations are S corporations. C corporations are usually larger corporations. If you are an owner of a sole proprietorship, or a partner is a partnership, or an owner of an LLC that pays taxes as a sole proprietor or a partnership, you may not be on your own payroll.
You are free to contribute or withdraw money from business accounts, subject to agreements with other owners, but you are taxed on your share of the net income of the business. When you contribute or withdraw money from business accounts, those transactions are not business income or expense. They are changes in owners or partners' equity in the business. That's shown on the balance sheet, and they have no effect on the income statement. If you are in a partnership, it is very important to record partner draws so all partners know that money was taken from the business.
A married couple has three options for ensuring that both spouses are paying into Social Security and Medicare.
One is to form a partnership or form an LLC and have the LLC be taxed as a partnership. Each spouse will receive a K-1 from the partnership or the LLC and will report that income on the 1040. Self-employment tax will be calculated for each based on the amount reported on the K-1.
Two, they can form an LLC and elect S corporation status. S corporation owners are paid as W-2 employees with Social Security, Medicare withheld from their paychecks.
The third option is to file taxes using Form 1040 and elect to be treated as a qualified marital joint venture. This election is made by filing two Schedule F forms, typically splitting the income and expenses 50-50, but other percentages may be used.
The qualified business income deduction, QBID as abbreviated, is a deduction from adjusted gross income equal to 20% of wages, self-employment, and rental income subject to restrictions for higher earners.
The Earned Income Tax Credit, or EITC, is a refundable credit, which means it is applied against taxes owed. And if the credit is greater than the taxes owed, the difference is paid to the taxpayer as a tax refund. EITC is only available to taxpayers with earnings within a certain range.
We will discuss this in more detail on the next few slides. QBID, or qualified business income deduction, is 20% of qualified business income subject to limitations. Qualified business income is anything that would be self-employment income plus income from rental real estate.
You owe 15.3% self-employment tax on self-employment income, but you get a deduction for 20% of self-employment income. Why does that make sense? Because it reduces income tax by amounts paid in self-employment tax, and that encourages self-employed people to pay into Social Security and Medicare.
Rental income is not subject to self-employment tax, but can count as qualified business income, or QBI. Why does that make sense? We don't know, but it's good for farmers.
Why is QBID particularly good for farmers? Most larger operations are structured so the family owns the land and rents it to a corporation, which is also owned by the family. The corporation provides liability protection and tax benefits to the family and pays rent to the family for the use of the land. This allows non-farming family members to benefit from rents but not participate in the farming operation. This also facilitates estate planning. Now, with the QBID, the rental income farm family members get is taxed most favorably because it is not subject to self-employment tax, and it increases the QBID or the QBI deduction. QBID is good for anyone with rental real estate.
QBI does not include wages, including reasonable wages paid from an S corporation or guaranteed payments made from a partnership.
QBID is limited if taxable income before the QBID exceeds approximately $170,000 for an individual or $340,000 for a married couple.
If QBID is limited, there is a complex calculation that takes into consideration W-2 wages paid by the business and depreciation deductions taken on property used in the business.
See the IRS webpage for more information on how QBID is calculated. We will continue to discuss QBID and its effect on the desirability of electing S corporation taxation in Lesson 4.
Tax deductions reduce taxable income, but sometimes taxable income is already below the threshold for owing tax, so more deductions do not improve the taxpayer's situation that year.
Tax credits act as payments against tax owed, but sometimes no tax is owed, so non-refundable tax credits do not improve the taxpayer's situation that year. Refundable credits will be paid to the taxpayer even if no tax is owed.
The earned income tax credit is fairly limited for people with no dependents. With one dependent, it is often between $1,000 and $3,000. And for 2 to 3 dependents, it is often between $2,000 and $6,000.
You can look at the tables for the EITC at the IRS website to see the range of when it kicks in and when it phases out for each filing status and depending on how many dependents you have. The tables are included in the instructions to Form 1040 after the income tax tables towards the very end of the instructions.
Earned income tax credit goes up as income goes up before it goes down as income continues to go down. If this situation applies to you, consider taking the least amount of depreciation allowed rather than the most depreciation allowed. You do this by electing straight line depreciation rather than the usual accelerated depreciation methods.
You must deduct all the expenses that are associated with the income you earn in your business. It is just as incorrect to overstate your income as to understate it. And if you overstate your income for purposes of falsely claiming an EITC, that is a form of tax fraud.
You may always elect tax treatments that are to your advantage, and you are encouraged to plan your activities to take advantage of tax provisions to minimize your taxes.
See the IRS website for more information about how to elect straight line depreciation.
There are a total of 5 lessons in this series. For each lesson, there is a short set of questions you can answer to help you decide if the training will be useful for you. Additional lessons are at the links in your resources.
You can also look at IRS Publication 225, the Farmer's Tax Guide, the resources at ruraltax.org, and at the IRS website and related publications. Thank you.